I would find assessing wealth a very, very difficult thing to do, apart from the fact that if you take away 2% of someone's wealth every year, it's not all that long before you have no wealth left.
You might be wondering what that guy was talking about at the beginning of this video. He was talking about the proposed wealth tax that the US is considering on people with a net worth of over $50 million. Now, when I first saw this video, I couldn't help but want to react to it. His argument is that if you chip away 2% of someone's wealth every year, it's not that long before that person has almost no wealth at all. And this is true. And thank God that me and you don't qualify for this wealth tax. Because to qualify, you need at least $50 million. Now, I didn't realize that the average viewer at CNBC had a net worth of $50 million. And what they forgot to factor in is that this $50 million in net worth is not stationary. The people who have this much money aren't going to let it sit and rot. They're going to put that money to work. That's how capitalism works. You use money to make money. So what is $50 million in year one is not likely to be $50 million in year two, even if you don't tax it, right? It's going to grow, and it's going to grow by more than 2%, because 2% is just inflation. So anyone who knows what they're doing is going to generate a return that is far greater than 2%. So it is clearly underestimating their wealthy viewership. And especially considering this is a business channel which gives investment and business advice. I just feel that they are insulting the intelligence of their own viewership. And when we look at this more objectively and reflect back on ourselves, many of us already pay a form of wealth tax. And it might even be greater than 2%, because I personally did a calculation, and apparently I've been paying a wealth tax close to 5%. Do you know what that is? And if you own a home, you probably already guessed, it's property tax. Most people who own property have to pay a property tax based on the value of your home. Now, did he just say that it is very hard to assess wealth? Then how on earth does the government assess the assess the value of my property and home and tax me accordingly? So even if it's hard, it's definitely not impossible and can be done. And when tax revenues are at stake, you'd be surprised at what the government can do. So he brings in his rich friend to discuss another alternative which is currently existing. Listen to this.
That's why they call it an income tax, so we can tax everybody on their income, which is the right way to do it.
He mentioned income tax, and that's the right way to do it. But income tax has a lot of loopholes that the rich has already found out ways. There are certain things that are taxed less, certain things that are taxed more, and more importantly, people are hiding income. There is a lot of legitimate ways to hide income. The problem with income tax is that it's incomplete and there's a lot of loopholes. And it's sort of built into the system. Ideally, you would think that being taxed on income makes sense and that is fair. But when you realize that people in positions of wealth and power have ways of sort of stalling or delaying that income tax and paying less overall. For example, capital gain is taxed at 50%. If you own your home and you buy another home and you sell your old home, you're not taxed at all. Right? There are games that wealthy people play that you and I just can't play. If you own a company and you leave the money in the company, that money is not taxed. So I just illustrated a few ways that people with money can avoid a lot of taxes. I should know, considering that I am an accountant. Let's watch the next clip on his perspective on the wealth, or as he put it, the balance sheet approach.
First off, I could have your top 4 accounting firms come in and do an audit on my balance sheet, and they would all come up with a different number, because what is the value? You can never establish the exact value of an asset until you sell it.
He does have a point. If you get 4 different accounting firms and ask them to value your company, it's very likely that they're going to get 4 different values. And depending on how big your company is, the range might be quite significant. But what he doesn't say is that if I get 4 accountants to look at my business, to look at my income, those 4 accountants can also come up with different numbers, because the way the accounting system works right now, and has always been working, there's a lot of room for interpretations. That's why Big 4 top accounting firms get paid so much money, because they really work in the gray area. And nothing in this world is black or white. But that doesn't stop someone from coming up with the value to tax you on, wealthy guy. For example, property tax is taxed on the value of your home. I brought this up previously, and somehow the government manages to assign a value to your property to tax. Now, much like the property tax, chances are the value that the government assigns to your wealth is probably less than the market value of your wealth, unless there is some publicly traded, unless you're owning a lot of liquid assets that have a public market value. The video continues, and they start discussing the stimulus package that's being doled out in the US. And he'll complain about how all his rich friends are getting money from the stimulus package. But it's at this point that the host realized something doesn't quite make sense. Let's watch their interaction.
But you said a moment ago, you know people who have lots of money who got those $2,000 stipends, or now it's going to be a $1,400 check. I thought only people earning $75,000, or households earning $75,000 or less got that money. Wasn't that the way that it was supposed to work?
Tyler, I don't think it's right. I don't think they're right there, okay? I know people that earn a lot of money that have gotten checks.
Here we see the fundamental flaw in only taxing income and not wealth. As they have clearly illustrated, and I have clearly illustrated before, you can have low income but high wealth. There's a lot of different ways a business, especially a business owner, can hide his income from his income taxes. For example, let's just say I'm a wealthy retiree with not a lot of money. I obviously don't need money, but my income might actually be low, especially if I don't take the money out of my business where all my money is stored. So in case of actually issuing out money for economic stimulus, you can't really tell who needs the money versus those who don't, just based on income. There should actually, I argue, there should actually be a wealth component to it as well. Because, like I said, you can be wealthy but income poor.